There is one number that tells you whether your trading plan makes money or loses money over time, and that number is expectancy, calculated by multiplying your win rate by your average win, then subtracting your loss rate multiplied by your average loss. And if that number is positive, your plan has edge. If it's zero or negative, your plan doesn't. And no amount of discipline or psychology changes that math. Expectancy per trade tells you how much you expect to make on average for every dollar you risk. So if your expectancy is 50 cents per dollar, risked then over 100 trades risking $100 each, you expect to make $5,000. Not because every trade wins, but because the math of wins and losses produces that average over sufficient sample. Here's how to calculate it. Take your last 50 or more trades and find three numbers. Your win rate, which is winning trades divided by total trades. Your average win, which is total dollars won, divided by number of winning trades. And your average loss, which is total dollars lost, divided by number of losing trades. Then plug those numbers into the formula. Win rate times average win minus loss. Rate times average loss equals expectancy per trade, and loss rate is simply 1 minus your win rate. Example: 50% win rate with average win of $200 and average loss of $100 gives you expectancy of $50 per trade, because 0.5 times 200 minus 0.5 times 100 equals 100 minus 50 equals 50. Meaning on average each trade produces $50 regardless of whether that specific trade wins or loses. Another example: 40% win rate with average win of $300 and average loss of $100 gives you expectancy of $50 per trade, because 0.4 times 300 minus 0.6 times 100 equals 120 minus 60 equals 60, showing that lower win rate with larger wins can produce similar or better expectancy. The critical insight: expectancy combines win rate and win size into single number that reveals truth about your system, because neither win rate nor average win alone tells you anything meaningful. A 90% win rate loses money if average loss is 10 times average win, and a 30% win rate makes money if average win is 4 times average loss. Most traders focus on win rate because winning feels good and losing feels bad. But expectancy doesn't care about feelings. It cares about math. And a system that wins 30% of time with large wins and small losses outperforms a system that wins 70% of time with small wins and large losses. If you don't know your expectancy, you're trading blind, because you have no way to distinguish between a plan that's losing money due to variance and a plan that's losing money because it has no edge. And this distinction determines whether you should keep executing or stop and redesign. Positive expectancy means your plan produces profits over sufficient sample and losing streaks are variance to be endured. Negative expectancy means your plan produces losses over sufficient sample and winning streaks are luck to be distrusted. And zero expectancy means you're paying commissions to break even, which is slow, guaranteed loss. The minimum sample size for reliable expectancy calculation is 50 trades, with 100 being more reliable, and 200 being where you start having real statistical confidence. Because expectancy calculated from 10 trades is dominated by randomness, while expectancy from 200 trades reveals the actual mathematical character of your system. Common mistake: calculating expectancy from your best month or your worst month instead of from complete data, because cherry-picking timeframes produces whatever expectancy you want to see rather than the expectancy that actually exists. Your implementation: pull up your trade log right now, calculate your three numbers from at least 50 trades, plug them into the formula, and look at the result. Because that single number tells you more about your trading future than any amount of chart analysis, pattern recognition, or strategy discussion ever will. Expectancy is the only number that tells you whether your plan works, because it combines everything, win rate, win size, loss size, into a single answer. And if that answer is positive, you have mathematical foundation for profitable trading. And if it's not, you have the most important information a trader can have. Proof that something needs to change before anything else matters.